Welcome everyone. Today we're conducting a thorough analysis of ASML Holding NV, the Dutch company that creates the most advanced machines used to manufacture the world's cutting-edge computer chips. We'll examine ASML's financial performance, dissect the risks facing the company, explore its growth prospects, and ultimately determine whether ASML represents an attractive investment opportunity in today's market conditions. ASML's position at the heart of the semiconductor industry makes it a fascinating case study in technological monopoly, geopolitical risk, and long-term growth potential. Here are the topics we will be discussing today in this video. ASML Holding NV designs and manufactures the lithography systems that are essential for semiconductor production. These massive machines, costing between 65 million euros for older deep ultraviolet (DUV) models to 350 million euros for next-generation high-NA EUV systems. It uses incredibly precise optics to project circuit patterns onto silicon wafers, essentially printing the circuitry that makes modern computing possible. The company's unique position stems from its absolute dominance in EUV lithography, where it holds 95% market share with no direct competitors. EUV technology is required for manufacturing chips at 7 nanometers nodes and below, making ASML indispensable for cutting-edge semiconductor production. With full-year 2024 revenues of €6 billion and approximately 42,000 employees worldwide, ASML serves virtually every major semiconductor manufacturer globally. However, customer concentration represents a significant characteristic of ASML's business model. Just 3 companies, TSMC, Samsung, and Intel, account for 77% of their total revenue. While this creates certain vulnerabilities, it also reflects the consolidated nature of advanced semiconductor manufacturing, where only a handful of companies worldwide operate at the leading edge of technology. ASML's business extends beyond equipment sales to include a growing services segment that provides maintenance, upgrades, and optimization for their installed base. This creates a recurring revenue stream that complements their more cyclical equipment sales. The company's competitive moat is protected by over 40,000 patents, decades of accumulated expertise, and the immense technical challenge of developing competing systems, advantages that have thus far proven insurmountable for potential competitors. Let's look into ASML Q4 earnings. ASML reported robust financial results for Q4 and full year 2024. Net sales for Q4 reached €2 billion, with a gross margin of 51%. For the full year, net sales totaled €6 billion, representing a 4.9% increase from 2023, with a gross margin of 51%. These results demonstrate ASML's resilience in a somewhat challenging market environment. Order intake remained strong with Q4 net bookings of €2 billion, reflecting continued investment by major semiconductor manufacturers in capacity expansion and technology upgrades. System sales were well distributed across technology nodes, with EUV systems accounting for €5 billion and DUV systems contributing €3 billion in Q4. This diverse sales mix highlights ASML's broad market appeal across different semiconductor manufacturing processes. Geographically, ASML sales showed significant diversification in 2024. For the full year, Asia accounted for 78% of net sales, with Europe and the US contributing 12% and 10% respectively. The company maintained a strong financial position with a cash balance of €5 billion at the end of Q4 2024, providing substantial flexibility for future investments and shareholder returns. Service revenue continued to grow as a percentage of total sales, reaching approximately 30% for the year. This segment delivers higher gross margins, around 70%, than equipment sales, approximately 50%, contributing positively to overall profitability. ASML remains committed to its share buyback program, with €1 billion remaining in the 2024 to 2025 program, reflecting management's confidence in the company's long-term prospects despite near-term market uncertainties.
Now we will be looking at ASML risks it faces. ASML's extreme customer concentration creates multiple vulnerabilities that extend far beyond simple revenue dependence. With just 3 companies, TSMC, Samsung, and Intel, accounting for 77% of total revenue, any capital expenditure shift by these customers has immediate, material impact. This was demonstrated when TSMC reduced their capital expenditure from $32 billion to $28 billion, directly affecting ASML's order book since EUV tools represent 35% of TSMC's equipment budget. This concentration significantly limits ASML's pricing power despite their technological monopoly. While they maintain premium pricing for advanced systems, they must negotiate with a very small set of powerful customers who could theoretically coordinate their purchasing strategies. The company also faces challenges from changing product mix dynamics, with their newest EUV systems selling for about €220 million each, up 8% from last year, while older DUV systems are declining in price to around €65 million. The dependency extends beyond just revenue. ASML's entire R&D roadmap must align with these key customers' needs, potentially limiting innovation freedom. Manufacturing schedules, capacity planning, and even long-term strategic decisions are heavily influenced by these three customers' roadmaps. If any of these relationships deteriorated, it would create both immediate revenue gaps and longer-term strategic challenges that would be difficult to overcome given the specialized nature of their equipment and limited alternative customers capable of purchasing their most advanced systems. Despite having the only technology of its kind on the market, ASML can't charge whatever they want because these few powerful customers could potentially work together on pricing. This concentration affects everything from product development to manufacturing schedules. Think of it like having only 3 major clients for your business. If one decides to leave, you'd be in serious trouble overnight. Geopolitical tensions represent ASML's most visible and complex risk. The semiconductor industry has become central to US-China strategic competition, with ASML caught directly in the crossfire due to their irreplaceable role in advanced chip manufacturing. As of early 2025, export controls restrict ASML from selling advanced EUV systems to China and have expanded to limit servicing of 14 Chinese fabs that previously accounted for 22% of their DUV system sales. With China representing 36% of ASML's total revenue in 2024, approximately €10 billion is potentially at risk from expanding export controls. The company expects this exposure to decrease to about 20% by 2025 through diversification, but this still represents a substantial revenue stream. Compliance costs have jumped 35% year-over-year to €210 million in 2025, creating additional financial burden. The situation is further complicated by numerous factors. Chinese customers are stockpiling older ASML equipment ahead of anticipated restrictions, creating short-term demand but future sales cliffs. Beijing is increasing investment in domestic alternatives to ASML technology, creating long-term competitive threats. Diplomatic relationships between the Netherlands and China are strained, potentially affecting other Dutch business interests, and ASML must navigate complex compliance across different jurisdictions with constantly changing rules. Most concerning is the potential for bifurcation in global semiconductor supply chains, where Chinese and Western ecosystems develop separately, potentially constraining ASML's total addressable market regardless of which path they choose. These multidimensional geopolitical challenges create both immediate revenue risk and fundamental strategic uncertainty that could permanently alter ASML's business model. ASML's supply chain represents an acute vulnerability that threatens their entire manufacturing capability. While they work with approximately 800 suppliers across 60 countries, they're heavily dependent on just 15 strategic partners who provide over 2/3 of their critical components. This concentration is particularly dangerous given that they maintain only about 3 weeks of inventory for high-value parts, compared to an industry standard of 8 to 12 weeks, creating minimal buffer against disruptions. The fragility of this system was demonstrated when ASML transitioned logistics centers in 2023, causing a 14% production delay despite careful planning. This vulnerability is magnified by the extreme complexity of EUV systems, containing over 100,000 precision components that must work in perfect harmony, with many specialized parts having no alternative suppliers. The most critical components are the optical systems from Carl Zeiss, which require multi-year lead times and cannot be quickly substituted. ASML's just-in-time inventory management practices further reduce resilience, while their financial interdependence with suppliers through financing programs covering over €2 billion means financial problems at smaller companies could ripple back to ASML itself. Geographic concentration of certain suppliers in regions like Taiwan creates additional risk given geopolitical tensions. The precision requirements, components manufactured with atomic-level accuracy where a deviation of just 1 nanometer could render a 150+ million euros machine useless, means even minor quality issues can cascade into catastrophic system failures. Currency fluctuations, transportation challenges for delicate components, and limited capacity to rapidly scale production of specialized parts create additional vulnerabilities. This complex supply chain represents perhaps the most overlooked yet potentially devastating risk to ASML's operations, with limited mitigation options given the specialized nature of their technology. The most critical components come from Carl Zeiss, which take years to produce and have no alternatives. Many parts must be manufactured with atomic-level accuracy. Even a 1 nanometer deviation, that's a billionth of a meter, could ruin a 150 million euro machine. It's like building a watch where changing a single gear by the width of a human hair would make the entire watch worthless. ASML reported robust financial results for Q4 and full year 2024. Net sales for Q4 reached 7.2 billion euros, with a gross margin of 51.9%. For the full year, net sales totaled 27.6 billion euros, representing a 4.9% increase from 2023, with a gross margin of 51.3%. These results demonstrate ASML's resilience in a somewhat challenging market environment. Order intake remained strong with Q4 net bookings of 9.2 billion euros, reflecting continued investment by major semiconductor manufacturers in capacity expansion and technology upgrades. System sales were well distributed across technology nodes, with EUV systems accounting for 2.5 billion euros and DUV systems contributing 2.3 billion euros in Q4. This diverse sales mix highlights ASML's broad market appeal across different semiconductor manufacturing processes. Geographically, ASML's sales showed significant diversification in 2024. For the full year, Asia accounted for 78% of net sales, with Europe and the US contributing 12% and 10% respectively. The company maintained a strong financial position with a cash balance of 5.0 billion euros at the end of Q4 2024, providing substantial flexibility for future investments and shareholder returns. Service revenue continued to grow as a percentage of total sales, reaching approximately 30% for the year. This segment delivers higher gross margins, around 70%, than equipment sales, approximately 50%, contributing positively to overall profitability. ASML remains committed to its share buyback program, with 7.1 billion euros remaining in the 2024 to 2025 program, reflecting management's confidence in the company's long-term prospects despite near-term market uncertainties. ASML's future growth depends on successful execution of their technological roadmap, particularly high-NA EUV systems. These next-generation machines represent the most complex lithography systems ever developed, requiring extraordinary precision that pushes the boundaries of physics. Components must be manufactured with accuracy at the atomic level, where a deviation of just 1 nanometer could render a 350 million euro machine useless. ASML has invested over 5.8 billion euros in high-NA development, with first customer shipments expected in mid-2025. However, this extraordinary technical challenge creates multiple execution risks. The promised 2x resolution improvement requires revolutionary optical designs that remain unproven at production scale. The larger system size, now requiring specialized fab floor reinforcement, creates integration challenges. The increased power consumption, 5% higher than current models despite efficiency goals, creates thermal management problems, and the system throughput targets of 185 wafers per hour may prove unattainable given these constraints. Early customer feedback indicates significant integration challenges at leading fabs, with concerns about floor space requirements, power consumption, and throughput. Any delays in this technology would create cascading effects across the semiconductor industry, as chipmakers' roadmaps for 2 nanometers and below processes depend entirely on these tools being available on schedule. Previous EUV generations faced multi-year delays from initial announcement to production readiness, and high-NA systems face even greater technical challenges. The extreme technical requirements for high-NA systems also limit ASML's ability to recover from design missteps, fundamental architecture decisions made years ago cannot be easily modified if problems emerge during integration. With Intel, TSMC, and Samsung all building their advanced node strategies around high-NA availability, any significant delays would not only impact ASML's revenue but potentially damage their reputation and strategic customer relationships. This technological execution risk represents perhaps the most significant threat to ASML's long-term market position. Any delays in this technology would create cascading effects across the semiconductor industry, as chipmakers' roadmaps for 2 nanometers and below processes depend entirely on these tools being available on schedule. While current demand appears robust due to AI investments, ASML remains vulnerable to the semiconductor industry's inherent cyclicality, a fundamental risk often overlooked during boom periods. The current semiconductor equipment spending surge, driven largely by AI acceleration, risks masking underlying cyclical patterns that have historically driven boom-bust cycles in equipment orders. Historical analysis shows semiconductor equipment spending typically follows 4 to 5 year cycles with 30 to 40% corrections from peak to trough. The memory market, which represents 28% of ASML's revenue, faces particular oversupply challenges with DRAM prices declining 18% in early 2025 despite strong AI server demand. This creates a bifurcated market where some customers are accelerating orders while others defer purchases. TSMC is ordering 55 EUV machines for AI chip production while Micron is deferring 12 DUV orders. With a workforce of 42,000 employees, ASML faces significant talent challenges that could undermine their technological leadership. They're experiencing 18% annual attrition in key technical roles, significantly above their 9 to 10% historical average and the 12% industry benchmark. This exodus is particularly pronounced in AI expertise, optical physics, and computational lithography, all critical disciplines for next-generation systems. ASML's Dutch tech salaries lag behind U.S. counterparts by 35% for critical positions like AI engineers and optical physicists, creating a persistent competitive disadvantage in global talent markets. This compensation gap makes it difficult to execute their ambitious plan to hire 6,000 additional R&D staff by 2027, particularly as U.S. semiconductor initiatives create unprecedented demand for the same specialized talent. Location is another challenge. ASML's main research center in Veldhoven, Netherlands struggles to attract international talent compared to tech hubs like Silicon Valley or Boston. The specialized knowledge needed combines rare skills in physics, advanced materials, and precision engineering, talents that every country developing semiconductor capabilities is fighting to attract. It's like trying to build a championship sports team when your competitors can offer much higher salaries and more attractive locations. Knowledge transfer poses another significant risk. Key system architects who designed early EUV systems are approaching retirement age with limited successors fully trained. In the hyper-competitive semiconductor industry, human capital is often the true limiting factor for innovation, making this talent risk particularly concerning for ASML's long-term technological leadership and their ability to execute increasingly complex development roadmaps. ASML's financial strategy faces growing pressures that create liquidity and strategic flexibility risks. Their ambitious €12 billion share buyback program running through 2025 is being scrutinized as capital expenditure requirements rise 18% to €3.5 billion for manufacturing expansions needed to meet projected demand. This creates a fundamental tension between returning capital to shareholders and investing in future growth capacity. The company has €5 billion in bonds maturing by 2027 at average 3.8% interest rates. While this debt load isn't excessive, their BBB+ credit rating, lower than many semiconductor peers, limits flexibility for refinancing in today's higher interest rate environment. Any ratings downgrade would significantly increase borrowing costs and potentially constrain capital access for their ambitious growth plans. Working capital requirements are also escalating as systems grow more complex and expensive. Each €350 million high-NA system requires approximately €175 million in working capital during production, creating cash flow timing challenges as production volumes increase. The company's capital allocation flexibility is further constrained by expectations for consistent dividend growth, 10 to 15% annually, alongside the substantial share repurchase program. More concerning is ASML's limited financial buffer against potential industry downturns. Their current liquidity position would support operations for approximately 2 to 3 quarters during a severe market contraction, potentially forcing difficult decisions about R&D investment continuity during cyclical downturns. The company faces tough capital allocation decisions between returning capital to shareholders, investing in capacity expansion, funding R&D, and maintaining financial flexibility. Any missteps could impair their ability to fund critical technology development or respond to market opportunities and threats. Working capital needs are also increasing as their systems become more complex and expensive. Each €350 million high-NA system requires approximately €175 million in working capital during production. This creates a fundamental tension between returning money to shareholders, investing in growth, funding R&D, and maintaining financial flexibility for downturns. It's like trying to save for retirement, pay for your children's education, and renovate your home all at the same time. Something eventually has to give. This divergence creates revenue mix uncertainty and potential production planning challenges. When ASML's 2024 earnings guidance leaked, showing these divergent trends, the stock plunged 16% in a single day, demonstrating investor sensitivity to cyclicality concerns. The situation is further complicated by customers' tendency to double order during supply constraints then cancel orders during downturns, creating phantom demand that distorts ASML's production planning. ASML service revenue provides some stability, but equipment sales still represent 70% of revenue and will remain highly cyclical. With average selling prices for EUV systems now exceeding €220 million, even small changes in unit volume have enormous revenue impact. The company's high fixed cost structure, significant R&D and manufacturing overhead, creates additional earnings volatility during downturns. This cyclicality risk is particularly concerning given ASML's premium valuation, which appears to discount potential down cycles despite their historical inevitability in the semiconductor equipment market. Intellectual property represents the crown jewels of ASML's business model, but this position faces growing threats from multiple directions. With over 40,000 patents covering critical aspects of lithography technology, they've created significant barriers to competition. However, this protection is increasingly challenged as geopolitical tensions create incentives for technology development outside traditional IP frameworks. Chinese competitors like SMEE and Watsing are accelerating development of competing lithography systems with substantial government backing, potentially benefiting from knowledge transfer through hiring former ASML employees. In 2024 alone, ASML identified 3 cases of intellectual property theft by employees with links to Chinese entities, highlighting the increasing risks to their proprietary technology. Additionally, as more countries pursue semiconductor self-sufficiency, the pressure for technology transfer through joint ventures or compelled partnerships increases. Trade secret protection becomes increasingly difficult with distributed global R&D teams, reliance on third-party researchers, and the necessary sharing of technical details with customers during integration. Beyond direct competition, alternative lithography approaches present long-term threats to ASML's dominance. Techniques like nano-imprint lithography, directed self-assembly, and e-beam direct write systems continue advancing and could eventually challenge ASML's position for certain applications. Multi-beam e-beam technology, while currently slower than EUV for high-volume manufacturing, continues improving and could eventually provide alternative pathways for some advanced nodes. Most significantly, if geopolitical tensions force a bifurcation of the semiconductor supply chain, Chinese government backing could accelerate development of domestic alternatives to ASML's technology at an unprecedented pace and scale. This intellectual property vulnerability represents a long-term existential threat to ASML's technological moat and market dominance. Now let's look at ASML long-term growth prospects. Despite these risks, ASML's growth potential remains exceptional, driven by 5 interconnected factors. First, their unmatched EUV technology leadership gives them a 95% market share in advanced lithography. Second, the AI revolution is creating unprecedented demand for high-performance chips, currently representing 33% of logic fab investments. Third, the continued push to extend Moore's law requires increasingly sophisticated manufacturing equipment only ASML can provide. Fourth, strategic partnerships with the world's leading chipmakers ensure ASML's technology roadmap aligns with industry needs. Finally, the expanding ecosystem of applications requiring advanced chips, from 5G to automotive to quantum computing, creates multiple growth avenues beyond traditional computing markets. These factors combine to create substantial long-term growth potential despite near-term challenges. According to ASML's Q4 2024 press conference, three fundamental drivers continue to support long-term growth. First, advanced nodes development continues as Moore's law extends to 2 nanometers and beyond, requiring ASML's cutting-edge EUV technology. Second, mature technology nodes continue to see strong demand driven by automotive, IoT, and industrial applications. Third, entirely new applications, particularly AI and high-performance computing, are creating unprecedented demand for specialized semiconductors. The company maintains its long-term growth outlook of 8 to 14% CAGR through 2030, though near-term market conditions show some softness in early 2025. ASML's position at the nexus of these three growth segments provides multiple avenues for sustained revenue expansion regardless of which specific applications dominate the market in coming years. A critical question for ASML's growth trajectory is how long the current AI boom will last. Based on industry analysis, we're seeing not a single cycle but multiple overlapping waves that will sustain demand throughout this decade. We're currently in the initial infrastructure build-out phase where companies like Nvidia, AMD, and new entrants are competing for AI training dominance, requiring the most advanced chips. By mid-decade, we'll enter the enterprise adoption wave as AI becomes embedded in business processes across industries, requiring specialized chips for different applications. Finally, toward the end of the decade, we'll see AI moving increasingly to edge devices, creating new chip architectures requiring advanced manufacturing. ASML benefits from all these waves, as each requires increasingly sophisticated lithography equipment to manufacture the specialized chips needed. ASML's technology roadmap extends well beyond their current EUV systems. The upcoming high-NA EUV systems, set to ship in 2025, will enable even more precise chip manufacturing at 2 nanometers and below. These systems, priced around €350 million each, represent a significant revenue opportunity as leading-edge manufacturers upgrade their capabilities. But ASML isn't stopping there. They're simultaneously advancing complementary technologies like deep ultraviolet lithography, metrology tools, and computational lithography software. This comprehensive approach ensures ASML remains essential at every step of semiconductor manufacturing, regardless of which specific architectures or chip designs win out in the marketplace. Each new manufacturing node presents unique challenges that only ASML's technology can solve. ASML's technology leadership in extreme ultraviolet lithography represents their most significant growth driver and competitive advantage. They remain the only company in the world capable of producing EUV lithography systems, with over 95% market share in the most advanced segment of semiconductor manufacturing equipment. This leadership position is protected by over 40,000 patents and decades of accumulated expertise that creates a moat competitors have thus far been unable to cross. Their current EUV systems, operating at a numerical aperture of 0.33, have become essential for manufacturing logic chips at 7 nanometers and below, enabling the performance advances driving today's computing revolution. The upcoming high-NA EUV systems, with a numerical aperture of 0.55, represent the next frontier in lithography. Based on their Q4 2024 press conference, these systems remain on track for first shipments in 2025, with the first system already shipped for process development. These systems will enable even more precise chip manufacturing at 2 nanometers and below, offering 2x resolution improvement over current EUV technology. These high-NA systems, priced around €350 million each compared to €220 million for current EUV tools, represent a significant revenue opportunity as leading-edge manufacturers upgrade their capabilities. TSMC, Samsung, and Intel have already announced plans to incorporate dozens of these systems in their advanced fabs, creating a multi-year order backlog. Beyond high-NA, ASML continues investing in next-generation technologies that will extend EUV capabilities even further, potentially enabling semiconductor manufacturing down to 1 nanometer and beyond. This continuous innovation ensures ASML remains essential at every step of semiconductor manufacturing advancement, creating sustainable growth as the industry pursues ever more powerful and efficient chips. Each new manufacturing node presents unique challenges that only ASML's technology can solve, creating a continuous growth pathway as the industry advances. While AI gets most of the attention today, several other emerging industries will drive significant semiconductor demand over the next decade. The automotive sector is rapidly increasing chip content per vehicle, with autonomous cars requiring 10x more processing power than today's vehicles. Industrial robotics and automation are accelerating post-pandemic, requiring specialized sensors and processors. Medical technology is incorporating more sophisticated chips for diagnostics and monitoring. Quantum computing, though early stage, will require specialized supporting chips manufactured using EUV lithography. Space technologies and green energy systems are also becoming increasingly semiconductor-intensive. The beauty of ASML's business model is that they benefit regardless of which specific end markets grow fastest. As long as advanced chips are needed, their lithography systems remain essential. AI systems require enormous computing power delivered through highly specialized, advanced semiconductor designs that can only be manufactured using ASML's lithography systems. The AI semiconductor cycle is not a single wave but rather 3 overlapping phases that will sustain demand throughout this decade. We're currently in the initial infrastructure build-out phase, 2023 to 2026, where companies like Nvidia, AMD, Google, and numerous startups are competing for AI training dominance. These efforts require the most advanced logic chips at 3 to 4 nanometers nodes, manufactured almost exclusively using ASML's EUV technology. TSMC alone has ordered 55 EUV systems specifically for AI chip production, representing over €12 billion in equipment orders. By mid-decade, 2025 to 2028, will enter the enterprise adoption wave as AI becomes embedded in business processes across industries. This will drive demand for specialized AI accelerator chips optimized for specific applications, again requiring advanced manufacturing nodes. Finally, toward the end of the decade, 2027-2030+, we'll see AI moving increasingly to edge devices, from smartphones to vehicles to IoT sensors, creating new chip architectures that require both advanced logic and memory components. Current projections show AI-related semiconductor content growing at a 36% CAGR through 2030, significantly outpacing the broader semiconductor market at 8%. With AI chips requiring 2-3x more silicon area than traditional processors and increasingly sophisticated designs, ASML benefits disproportionately from this trend regardless of which specific AI chip designers or architectures ultimately dominate the market. The automotive sector is rapidly increasing chip content per vehicle as electrification and autonomous technologies advance, from approximately €600 in semiconductor content per vehicle today to a projected €1,600 by 2030. Advanced driver assistance systems alone are expected to drive a 26% CAGR in automotive semiconductor demand through 2028. Industrial robotics and automation are accelerating post-pandemic, with industrial semiconductor content growing at 22% annually as factories implement sophisticated vision systems, real-time control, and intelligent monitoring that require specialized processors and sensors. Medical technology is incorporating increasingly sophisticated chips for diagnostics, monitoring, and treatment. Medical imaging devices now utilize advanced SoCs similar to those in high-end smartphones. Quantum computing, though early stage, requires specialized supporting chips manufactured using EUV lithography for control systems and interface electronics. Space technologies, with satellite constellations expanding dramatically, require radiation-hardened advanced semiconductors. Green energy systems rely increasingly on sophisticated power semiconductors for grid management and efficiency. The metaverse and augmented reality require exceptional graphics processing power in increasingly compact forms for headsets and wearable devices. Data security applications, from encryption to secure enclaves, demand specialized semiconductor designs with advanced features only possible at leading-edge nodes. The beauty of ASML's business model is that they benefit regardless of which specific end markets grow fastest. As long as advanced chips are needed, their lithography systems remain essential to the manufacturing process. This diverse application landscape creates resilience in their growth trajectory beyond any single industry's development cycle. According to ASML's Q4 2024 earnings report, the company's sales showed strong geographical diversification. For the full year, Asia accounted for 78% of net sales, with Europe and the US contributing 12% and 10% respectively. While export restrictions have limited some sales to China, reducing exposure from 36% to a projected 20% by 2025, ASML is expanding in other regions to more than offset this potential limitation. The global push for semiconductor sovereignty is creating new manufacturing hubs beyond traditional centers, with significant investments in the US, CHIPS Act, $52 billion, Europe, European CHIPS Act, €43 billion, India Semiconductor Mission, $10 billion, and Southeast Asia, various incentives. These initiatives are attracting new fab construction across multiple regions, diversifying ASML's customer base geographically. ASML is strategically positioning manufacturing and service capacity in these growing regions to serve customers locally, recently expanding operations in the U.S. with a $200 million investment in their Wilton, Connecticut facility, and planning a new €240 million campus expansion in the Netherlands. They've also announced plans for a new reuse and repair center in Beijing, maintaining a foothold in the Chinese market for servicing and refurbishing older systems while complying with export restrictions. Beyond established markets, emerging semiconductor manufacturing in countries like Vietnam, Malaysia, and potentially Brazil and Mexico creates additional growth opportunities as regional manufacturing ecosystems develop. These new markets typically begin with mature nodes but gradually advance toward more sophisticated manufacturing requiring ASML's advanced systems. This geographic diversification ensures that geopolitical challenges in any single region won't derail ASML's growth trajectory, while simultaneously enabling the company to capitalize on the worldwide semiconductor manufacturing renaissance driven by supply chain security concerns. The breadth of this expansion creates resilience in ASML's growth prospects regardless of how specific regional tensions evolve. Service revenue represents an increasingly important growth vector for ASML that provides stability, enhanced margins, and significant expansion potential. With a secured 5-year backlog valued at €24 billion and impressive 70% gross margins, compared to approximately 50% for equipment sales, this segment provides substantial financial stability while improving overall company profitability. Each EUV system installed today generates approximately €20 million in service revenue over its lifetime, a figure expected to reach €30 million for High-NA systems due to their increased complexity. As the installed base of EUV and High-NA systems grows throughout this decade, so does the recurring revenue opportunity, potentially reaching €40 billion in service backlog by 2030. ASML is expanding beyond traditional maintenance into system upgrades that improve performance of existing equipment, software services that optimize lithography processes, and the refurbishment of used lithography systems for secondary markets. These higher-value services grow ASML's share of wallet within existing customer relationships while creating new revenue streams. The service business helps smooth out the cyclicality inherent in equipment sales, as maintenance continues regardless of whether customers are currently purchasing new systems. This provides financial stability during industry downturns while giving ASML valuable insights to improve future system designs. Service revenue also has strategic value beyond financial contributions. Regular service interactions create ongoing touchpoints with customers, reinforcing relationships and providing early insight into future needs. The sticky nature of these service relationships, with 92% customer retention rates, creates significant switching costs once a customer standardizes on ASML equipment, further strengthening their competitive position. As this segment grows from 30% of revenue today to a projected 35% by 2030, it will increasingly influence ASML's financial stability and valuation multiples. ASML expects low single-digit revenue growth in 2025, with Q1 net sales projected at €5 to €5.5 billion and a 50% gross margin. Management is cautiously optimistic about a recovery in the second half. Long-term, ASML targets annual revenue growth of 8 to 14% through 2030, aiming for €44 to €60 billion, driven by AI demand, Moore's law scaling, and broader semiconductor adoption. Gross margins are expected to reach 56 to 60% by 2030. EPS growth will be supported by margin expansion and a €12 billion buyback, despite near-term R&D and compliance cost pressures. ASML ended Q4 with €5.0 billion in cash, ensuring flexibility for investment and shareholder returns. Technologically, the High-NA EUV system is on track, with the first unit shipped. ASML sees strong long-term demand across advanced and mature nodes, and remains committed to its €7.1 billion remaining buyback, reflecting confidence amid short-term challenges.
So now we will be looking at ASML stock evaluation, and that will be done using this tool. And so, for example, for this, we'll be using discounted cash flow model and forward sales. So here are some of the input values that I've already placed inside here, and these valuations are conservative but realistic in my opinion. The input reflects ASML's strong fundamentals, but also accounts for risks such as geopolitical tension, supply chain fragility, and market cyclicality. And so based on that, these are some of the conservative and then some of the optimistic scenarios that I input. And based on that, I will be using a 10-year projection rate. So now, and these are just my assumptions, which kind of aligns with my investing strategy. So based on that, let's hit the calculate button and see. So if you're using, so based on the discounted cash flow model, so as of now, it's considers to be undervalued based on the low. And if you believe in mid, then it's a buy all day, and so is on the high and even on the low. So based on that, excuse me, so this is and also based on forward sales valuation model, it seems like the intrinsic price, it's still at a fair value and considered a buy. And honestly, this is just my opinion and based on my conservative. If you believe in these assumptions, then yeah, it's a buy all day. And however, this is just my opinion and what I believe it should worth. After my thorough analysis, yes, I believe ASML to be a buy. It represents a compelling long-term investment opportunity through not without, however, although it doesn't come without any significant risks that warrants careful position sizing. So this company's monopolistic position in EUV lithography is essential role in semiconductor manufacturing and projection of 8 to 14% annual growth rate through 2030. It provides exceptional long-term potential. And someone like me who's a long-term investor with strong conviction in this company or in semiconductor industry growth trajectory. So I believe ASML represented attractive opportunity to gain exposure to foundational technology that enables AI, high performance computing, and enormous other growth industry. The company's irreplaceable role in semiconductor manufacturing process creates a sustainable competitive advantage that is extremely difficult to replicate. So, however, customers' concentration, geopolitical tension, and technological execution risk creates meaningful near-term uncertainties that cannot be ignored. A prudent approach would be to be scaled position strategy, which I'm currently following, and establishing an initial 2 to 3% portfolio position, which I've done. And based on that, as when it becomes undervalued or significant undervalue, I continue to add more to it until it reaches my target goal of position and I'm okay with the risk that I'm taking. Um, for more risk adverse investors based on current market, semiconductor ETFs that includes ASML alongside of other industry players provide a diverse exposure to semiconductor growth without the concentrated risk of a single company. Alternatively, maintaining SML on a watch list for potential entry during temporary setback, like the 60% drop we experienced, could provide more favorable entry points. However, like I said, this is all of my opinion. For investors with strong committed to the semiconductor industry future and conviction in ASML ability to maintain its technological leadership, this company represents a rare opportunity to invest in true monopoly at the heart of one of the most important technology trends of our time. While risks are there, the combination of strong competitive position, diverse growth drivers, and essential nature of their product makes SML a cornerstone technology investment for the coming decades. And as mentioned before, these insights are solely my opinion and conclusions drawn from my personal research, and they should not be considered financial advice. Investing always comes with inherent risks. It is crucial to invest in areas you understand rather than speculating. So before making any investment decisions, I strongly advise conducting your own research through due diligence. Thank you for watching and supporting the Research and Investment channel, and I look forward to seeing you in the next videos. Thank you.